right. This is the Investor Coaching Show. Paul Winkler, Evan Barnard, and Ira Work. So one of the things that I have done over the years many times, especially during market downturns, is try to just give people a little bit of a sense of when they're reading publications and they're reading about what's going to happen next. And I'm thinking about it. Why do we turn to TV shows on finance? Why do we turn to magazines? Why do we turn to newspapers? Why do we listen to talking heads about what the market's doing? Really, especially during market downturns, is because we want a prediction about the future. Right. Mm-hmm. I want somebody to tell me what's going to happen. Am I going to be okay? Mm-hmm. And preferably somebody that seems smarter than I think myself to be. So I turn to the TV programs. And of course, there's always somebody that has an opinion on what's going to happen.
Yes.
Continually. So what I did is with Scott here in the Goodlettsville office, I said, hey, Scott, would you go and look back at some of my videos that I did back in 2008 during the big market downturn and just, pull up some stuff and just remind me of some things I had done. And he goes, Paul, bad news. We don't have any of those videos anymore. I was like, okay. But I'm going to tell you one thing that I did a lot of. I did a lot of digging through the media and what the media was saying was going to happen and then comparing it to what did happen. So I was in 2008, but I went back to 2000, 2001, 2000. I made a visit to the library one time. That workshop that we taught for many years, mm-hmm. and we still teach. But I used to have articles going back to the 1930s and back in time in 1970s. And where I got that was in a single day in the Nashville Library, actually digging up articles and going, okay, here's what they said was going to happen. Here's what ended up happening. So mm-hmm. I said, hey, Scott, could you just go do this again for me? And I said, I don't care. Just make it the last 20 years so it seems relevant to people. So he did that. And he did a bang-up job, too. So let me just read some of these headlines for you. Number 1, 10 stocks to last the decade was one of the articles that he came up with. A few major trends will likely shape the next 10 years. Here's a buy and forget portfolio to capitalize on them. So you can just buy this portfolio. You hear this, many places? Yeah, you do. Okay, first stock that they actually came up with is Nokia. Nokia, from the time that this article was written over the next 10 years. So the article was written in August 14th to be exact, of the year 2000. So we're talking about that the market had already started turning down, right? Because it started turning down in March, right?
Yeah.
Down negative 72.94%. That was a stock that was to last the decade. Okay.
It did last.
It did. Yeah. I guess it did last. It didn't go down 100%. Nortel was the next one. Nortel, filed for bankruptcy in 2009.
It did not last.
It did not last. No, it did not. Enron was one of the stocks famously noted for a big bankruptcy in December of 2001. And a lot of people got really hosed on that one. The next stock that was going to last a decade was Oracle. It only went down 43%, 43.38% over the next 10 years, according to Morningstar. Broadcom was the next one. Acquired by Avago Technologies, 2016. We couldn't find the return from 2010, but anyway, it's not even in there anymore. Viacom split into multiple companies, sold for 2005. Another really great winner of a pick. Univision sold 2007. Charles Schwab still around, but a negative over that period of time for the next 10 years. Because remember, these are 10 stocks to last a decade, 10 years, right? Down 43% over the next decade, 43%.
Wow, that actually surprises me.
It did surprise me as well. And I had to check it. Scott did the data, and I went back and checked it. And according to Morningstar, yes, correct, that is exactly what it was. Down 57.63%. Morgan Stanley was down 63%. 63%. Morgan Stanley Dean Witter was another one of the selections here. And Genentech was acquired by Roche in 2009. So much for the 10 stocks to last a decade. Next one that he found was CNN, Wall Street, sell in May and go away. Now, we've heard that. You need to sell your stocks in May and then go away for the summer. And this is in May of 2008 that this was written. And they said, April was strong to the other one. And they says, no, this doesn't apply. This old standby does not apply this time. No, you need to stick this one out. This is good. You need to not listen to the sell in May and go away in this particular article.
Mm-hmm.
And yeah, you probably should have, because the next 12 months S&P was down 35%. So they were wrong. Again, they said that it was not going to go down. The market was going to stay up and do well, and it went down. So,
but to clarify,
yes,
we're not saying use the strategy of sell in May and go away.
No, if you look at that, I've done plenty of videos on that to show that it's the odds of it being down is pretty much the same as the odds in other time periods of it being down. So, because if you diversify more, it doesn't work. Anyway, stock market rebound was the next article from ABC News. What should investors do? And this was written in September of 2009. It says, now stocks up 50% since the market bottom of early March. I'm sure many of the same investors are thinking this time it's the time to jump back in, that it's safe to invest again. I say, think again, says this Wall Street strategist. Just as I doubted the March stock rally would fall an additional 40 to 50%, I now doubt the Dow will rise or that it will skyrocket another 50% over the next 6 months. And yeah, he was right. It didn't skyrocket, but it did go up, the S&P, from October of 2009, when this article came out, over the next 6 months to March of 2010 by 12%. And the CRSP, Center for Research and Securities Prices, 6 to 10, which is small cap index, up 14%. And the FAMA French Small Value Index was up 16.5%. So again, this writer, probably a very smart person, was just as wrong as they could be. Let's see, moving right along. No recession, but, says Bloomberg. So they said December 19th of 2007, Business Week forecast, they asked 54 forecasters in their annual outlook survey for their views on everything from housing to credit crunch to Fed policy and global growth. I said, bottom lines look like this. The economists project on average that the economy will grow 2.1% for the fourth quarter of 2007 to the end of 2008. Well, how did they do? Only 2 of the forecasters expected a recession out of 54. 52 of them blew it. Out of 54, 52 of them blew it. I mean, that reminds you, remember that
That's
thing?
not even 50-50.
No, it isn't. It's not even close to 50-50. Remember that one where they had the economists predicting whether the interest rates would go up or go down? You got a 50-50 shot. Are they going to go up or are they going to go down? And it was like 70% of them got it wrong. Which is not. And these are economists. These people are smart. They're not stupid.
My brain is seizing up. I was trying to find the article that we use in the presentation. I can't remember the guy's name of, the Suckers rally coming out of 2009. I'm drawing a blank.
Matter of fact, I actually sent that to Michael Del Giorno. Sent me something this week. And he said something to me. He sent me something, and I said, "Oh yeah." I said, "Here was the article that we use quite often. New York Stock Exchange CEO seen cautious over the March rally, according to Reuters."
Yeah.
And the beginning of the article says the real money investors sat out the March rally and are probably waiting for a second one around June or July. The head of the world's biggest stock exchange, the New York Stock Exchange, said in a newspaper interview. Article was written in March of 2009, and it preceded a large and rapid upturn in the market. And I said to Michael, I said, if they truly waited until June, the earliest month mentioned to get back in, they missed a nearly 26% return in large U.S. stocks as measured by the S&P 500 and over a 53% return in small companies as measured by the CRSP 910.
In 3 months, not for the year, just in those 3 months.
Yeah.
Yeah.
You missed. And I because Michael had sent me an article about something about how low could stocks go was the article that he sent me. And that was my response to him in a text message.
One of the things I love about that article is the line where he says, the real money investors.
The real money investors.
I'm trying to figure out, like, for the last 12 years, what does he mean by real money?
Yeah. As opposed to fake money investors.
Right. I mean, I don't know. None of our clients bring me monopoly money.
No.
I mean, it's real money.
Yeah, I don't know what criteria have to be met.
And this is the head of the New York Stock Exchange.
It is. That's what gets me. Is here's a guy that's the head of like the
biggest stock exchange in the world.
Yeah, it's the big dog. So if anybody should know where the market's going to go, you'd think that would be the person. Will the stock market crash in 2018? Was the next article that Scott brought up from Fortune magazine. You could lose a fortune reading things like this, apparently. Here's what Wall Street predicts. As in, this road is making predictions in New York City. There's a road. Did you guys know that? There's a road in New York City that makes predictions. I always like that. Here's what Wall Street predicts. It just cracks me up. U.S. equity market, as measured by the S&P 500, has surged 20%. To 2680 this year as the American economy continued its recovery and investors look forward to corporate tax cuts promised by the Trump administration. Indeed, some 14 Wall Street banks expect the index to rise another 5% to 2818 in the coming year, courtesy of tax cuts and continued strength in the global economy. Well, so I would think we'd look at this and we go, well, tax cuts we know are usually pretty good. And they're saying that the market's going to go up.
Mm-hmm.
But the market went down. Well, why did it go down? In 2018, it went down 4.4%. They expected it to go up, but it went down. Well, why? Well, because maybe those tax changes were already baked into stock prices.
Right.
Which is what the stock market does. So when we see that, that we're predicting the market direction, we're making the assumption that whatever's going on is not baked in, as we often talk about.
Yeah.
Now, rich dad, poor dad.
Uh-oh.
Yeah. Okay.
He's selling gold right now.
Oh, I know.
Buying or selling?
He's selling.
It was, which is really interesting
now
to
that
see
it's down 20%.
The price of gold is down. That's great. That's really good. That was I don't think that I would have liked to have gotten on that bandwagon. How do you look at yourself in the mirror is what I wonder. But anyway, Robert Kiyosaki, biggest stock market crash in history coming.
Uh-oh.
Biggest one's coming now. So 2016 is when he said this is going to happen. So there's going to be a major market crash in 2016, he says. So this was written on June 28th of 2015. And I just took the data to September 28 of 2022 this year. Stocks are up 92.47% from when this big crash was to occur.
And that's after giving up the 2022 performance.
Yes.
It's still up 100%.
Yes, almost 100%. Yes, and that is measured by the S&P 500 for those in our compliance department. Then you savers will be losers. Baghdad is the next city to fall. Hyperinflation will come. You look at inflation during the period of time, it was tame. It wasn't until now that we've had a bunch of inflation. So he was predicting that inflation was going to be awful.
Yeah, it was an average of 1 over those first 4 years.
Yeah, buy gold and silver, he said. So at least he's still sticking with gold and silver, despite the fact that it's been a horrendous run. So anyway, here's the point, folks. Here is the point. You're going to see more people come out of the woodwork trying to tell you where market's going to go. You may be even tempted yourself to try to figure out where markets are going to go, what's going to happen next. Recognize that nobody seems to have this magical ability. And if they did, they probably wouldn't tell you. It would be much better to keep it to yourself. And recognize that it's just not something that you're going to probably help yourself in your portfolio trying to figure out where things are going next. So just, if it just helps you just to ignore the media, if that's what helps you, then by all means, ignore the media. And if it helps you to ignore your friends and family who are actually listening to the media, because you're going to get it secondhand from them.
Right.
You really are. So you may just need to ignore everybody and go and
set your alarm to listen to the Paul Winkler Investor Coaching Show 3
and
p.m.
take a walk outside and listen to the birds and listen to all the things. Just
enjoy life.
Live
That's
life.
Right. That's right.
Live life and enjoy life, because recognize that nobody has a beat on the future.